Hello again, fellow BeachBum traders. Thank you for watching our video on the options wheel strategy for beginners, part 1. This is part 1 in our series of videos on the options wheel strategy for beginners. In this first video, we will explain what the options wheel strategy is, and we'll also review how the options wheel strategy can be used as a long-term strategy for consistent income. Again, we'll go through detailed step-by-step on how you can use the options wheel strategy as a long-term strategy for consistent income. We'll go through a number of examples using different asset classes and how the options wheel strategy can be used with different asset classes, including cryptocurrency, as a long-term strategy for consistent income. So again, stick around through the video. And again, this is part 1 in our series of videos on the options wheel strategy for beginners. So we hope you will subscribe to our BeachBum Trading YouTube channel and hit the bell icon to be notified as we release further videos in this series on the options wheel strategy for beginners. So let's get started.
01 from ChatGPT. Question equals, what is the options wheel strategy? Answer equals the options wheel strategy is a complex options trading strategy that involves buying and selling options with different expiration dates in order to profit from changes in the underlying stock's price. It involves constructing a wheel of options with different expiration dates, with the goal of earning a profit from the differences in the prices of the options. The strategy can be used for both call options, which give the holder the right to buy the underlying stock at a certain price, and put options, which give the holder the right to sell the underlying stock at a certain price. There are several variations of the options wheel strategy, and it can be a risky strategy due to the complex nature of options and the potential for significant losses if the underlying stock does not behave as expected. As such, it is important for traders to have a strong understanding of options and risk management before attempting to use the options wheel strategy. Wheel strategy. A long-term strategy for consistent income. The wheel strategy, aka options wheel strategy, is a two-step buy low sell high income strategy used by stock options traders who sell cash-secured puts and covered calls in order to receive stock at a discount, and then sell at an above-market price. With just a few small adjustments, crypto traders can also benefit from this strategy. Step 1. An investor continually sells, writes, out of the money, OTM, cash-secured puts to collect option premium. If at the predetermined expiration date the option expires worthless, the writer keeps all the premium, repeating the process until a put eventually expires in the money, ITM. A put option expiring in the money, ITM, exercises automatically. Unlike traditional equity options where a physical transfer of ownership takes place when exercising an option contract, Bybit's USDC crypto options are cash-settled. Here, no position transfer takes place. Instead, the option seller's account is credited or debited to the associated cash, USDC, position. Example. The investor sells one BTC $20,000 put option and receives a $2,000 premium from the buyer. The option contract expires at a settlement price of $19,000 and the seller's account receives a credit of plus $1,000 USDC, strike price, settlement price plus premium received. At this point, the option seller enters the market and purchases one BTC, before moving to step 2 of the wheel strategy. Step 2. Now holding the underlying crypto asset, the investor sells out of the money, covered, calls to generate a consistent income. When a call option eventually expires in the money, there are two available options. Option 1. Sell the underlying crypto asset and return to step 1 selling cash-secured puts. Option 2. Keep the underlying asset and continue selling covered calls to generate income. Wheel strategy setup. The most important factor when using the wheel strategy is ensuring your trading account has enough capital to cover the difference between the strike price and the settlement price if the option expires in the money. Here, the account balance guarantees the short put as cash secured. Selling a put option is a high-risk strategy with limited upside, collected premium, and significant potential downside. The difference between the strike price and the settlement price, minus the premium received. For this reason, the chosen strike price should represent a level you are happy to open a long-term position in the underlying asset. Choosing which put to sell. When deciding which put option to sell, there are two main considerations. How far out of the money, below the current market price, should the strike price be to achieve the desired result, either expiring worthless or being exercised? How many days to expiration, DTE, should the option have? If the goal is for the option to expire worthless, collect premium. Selling a put with a strike price way below the current market price works better. The lower the strike price, the less chance the option will expire in the money. The trade-off is that option premiums decrease the further out of the money you go. If the aim is acquiring the underlying crypto asset, choose a higher strike price you believe will expire in the money, ideally not by too much as to offset the amount of premium received. Before deciding which maturity, expiration date, to sell, consider how the option premium changes over time. All options lose value, time decay, as the expiration date draws near. We can measure exactly how much value an option will lose by using theta. Theta is an options Greek measuring the rate an option premium declines over time. As an option moves closer to expiry, time decay speeds up. At expiration the option has zero time value. A handy way to visualize theta is to imagine a snowball rolling down a mountain. At the top of the mountain, the snowball LL is small and moving slowly. As it rolls further down the mountain, it speeds up, growing larger along the way, until it reaches the bottom, expiration. An option with a theta of -0.50 will lose 50 cents each day, whereas an option with a theta of -2.00 will lose $2 per day. Theta is always represented as negative as it always has a negative effect on an option's price. Theta is lower for longer dated options, price decays less, and higher for near dated options, price decays more. Theta is highest for at the money, ATM options. The strike price is equal to the current price of the underlying asset, decreasing when a strike price moves further into the money or out of the money. For best results, selling near dated puts with between 30 to 40 DTE offers a good way to maximize time decay whilst not being tied to a less flexible longer-term contract. Choosing which call to sell. In the same way the account balance secures the short put, the underlying asset provides the cover for the short call. For this reason, you must hold the underlying crypto asset while the short call contract is active. When choosing which strike price to sell, consider the same factors used to determine which put to sell. How far out of the money, above the current market price, should the strike price be to achieve the desired result, either expiring worthless or being exercised? How many days to expiry should the option have? Similar to the put, selling a near-dated call option with between 30 to 40 DTE offers a good mix of value and flexibility. Wheel strategy. Another useful metric to help decide which strike prices will work best when using the wheel option strategy is delta. Delta is the amount an option premium changes for every $1 change in the underlying asset. Call options have a positive delta ranging between 0 and 1, whereas put options carry a negative delta ranging between -1 and 0. For call options, the delta tells us how much the price will rise when the underlying asset ticks higher by $1 and how much the price will drop when the underlying asset drops by $1. This works in reverse for put options, which lose value when the underlying asset rises, and gain when the underlying assets fall. Typically, an at-the-money call option will have a delta of, or close to 0.50, meaning the premium will plus or minus 50 cents for every $1 move in the underlying price. Delta decreases as a call option moves further out of the money, higher than the current market price, and increases when a call option moves deeper into the money, lower. The opposite is true for put options. Delta is simply the options market's way of telling us the odds of a strike price expiring in the money. All things equal, an at-the-money option has a 50% chance of expiring in the money, and thus is a 50-50 bet, whereas a 0.20 minus 0.20 delta has a 20% chance of expiring in the money. Higher delta equals higher chance of expiring ITM. Lower delta equals lower chance of expiring ITM. Whom the wheel strategy is for. The wheel option strategy is suitable for investors with a good working knowledge of options trading. Because crypto options are cash settled, traders must always remember to acquire the underlying asset when a short put expires in the money and sell, if that's the aim, when a short call expires in the money. For this reason, the wheel option strategy is best suited to more experienced options traders. When to use the wheel strategy. Sideways trending markets with wide trading ranges and clearly defined support and resistance levels, Round numbers are often best. Works great for the wheel strategy, giving you several ways to yield positive returns. Generate passive income, when the options expire worthless. Lower the cost basis of acquiring an underlying crypto asset. Short puts expire ITM. Increasing the net sale price of the underlying asset. Short call expires ITM. Break-even point. The break-even point is the price at which an option strategy is neither making nor losing money. Because the wheel strategy has lots of moving parts, we can't pinpoint a specific break-even point. Instead, we must look at each individual component to work out their respective break-even points. Cash secured put. Break-even point. The break-even point when selling a cash secured put is when it expires in the money, below the strike price, equal to the amount of premium received. For instance, the investor sells one BTC $20,000 put option, receiving a premium of $2,000 from the buyer. Here, the break-even for the put writer is $18,000. If the put expires at $18,000, their account is debited minus $2,000, strike price, settlement price, and receives a credit of $2,000, premium received. Because the wheel strategy involves acquiring an underlying asset and then selling calls against it, we must also factor in the price of acquiring the underlying asset into our calculation. Typically, the option seller buys the underlying crypto asset when the put option expires. Choosing not to can impact profitability in three ways. Neutral outcome. The writer purchases the underlying asset at the same level as the settlement price. Settlement price of $18,000. Purchase price of $18,000. No change. Positive outcome. The option writer purchases the underlying asset below the settlement price. Settlement price of $18,000. Purchase price $16,000. A saving of $2,000. Negative outcome. The writer purchases the underlying asset above the settlement price. Settlement price of $18,000. Purchase price of $20,000. A loss of $2,000. Note: to reduce risk, you should purchase the underlying asset immediately if the short put option expires ITM. Covered call. Break-even point. We can work out the break-even point for a covered call by calculating at which point the premium no longer offsets a drop in the underlying asset when the option expires. Assuming an investor acquires one BTC at $20,000, then sells an out-of-the-money call option, collecting a $2,000 premium, the break-even point is $18,000. Here, the $2,000 premium offsets the $2,000 drop in the underlying asset. Wheel strategy sweet spot. The sweet spot of an option strategy refers to the optimal price at the expiration date. Just as a wheel option strategy has more than one break-even point, it also has several sweet spots. Cash secured put. Sweet spot. When selling a cash secured put, the ideal settlement price is when the underlying is equal to the strike price. Here, the option expires worthless and the seller keeps the premium. Covered call. Sweet spot. Similar to the cash secured put, the sweet spot for a short covered call is when the option expires at the money, expires worthless. The seller keeps the premium, and assuming the call was out of the money when sold, the value of the underlying asset will be higher. Adjustments to make in bearish markets. One of the main advantages of trading options is their flexibility. Unlike trading spot or perpetual futures where the only choice is whether to keep the position open or close it, options traders have several ways to adjust their position during adverse market conditions. Let's assume BTC is trading at $22,000 and an investor sells one BTC $20,000 put option with 40 days to expiry and receives a $2,000 premium, believing the price will be close to $20,000 at expiry. Halfway through the contract, now with 20 days to expiry, the investor becomes more bearish, believing BTC may trade down to $18,000 before the option's expiration date. The underlying price has dropped $500 to $21,500 and the option premium is still $2,000. The time decay has offset the negative price movement of the underlying. Here are some ways they can adjust the position to reflect their new, more bearish outlook. Close the position and wait to sell a lower strike if the short put is closed and BTC slides to ARD's $18,000 before the expiration date. The investor can sell a lower strike price with a similar amount of time to run, lowering their break-even price whilst receiving an amount of premium equivalent to that collected when writing the $20,000 put. Buy a protective put option at a lower strike price. Buying a further out-of-the-money put transforms the cash-secured short put into a lower-risk bull put spread. The protective long put caps the amount you can lose from the short put, and because the strike is lower, it will cost less than the premium collected on the written short put. The payoff diagram for the bull put spread shows it limits the potential loss, no matter how far in the money the lower put expires. Rolling down. Rolling down involves closing an open short strike and opening a new short position in a further out of the money strike in its place. Rolling up is the opposite and involves closing an open strike and opening a higher one. In this example, the investor buys back the $20,000 put and sells a strike closer to $18,000. Of course, being further out of the money, the new strike will generate less premium and have lower theta. The benefit here is that the new strike has lower delta and thus is less likely to expire in the money. Maximum take profit potential. Because the wheel strategy is multifaceted, in theory, there are several ways for it to play out at maximum profitably. The short puts rarely, or never expire in the money, and the option writer generates a steady and reliable income. A short put expires at the money, worthless. The writer keeps the premium, buys the underlying crypto asset which duly rallies, and the investor writes covered calls to generate additional income. Here, the investor profits from the capital appreciation of the underlying asset and the received premiums. Once holding the underlying asset, it trends higher and the investor continually writes covered calls which rarely, or never expire in the money. Maximum incurred loss potential. To understand the potential losses when trading the wheel strategy, we need to break it down into two parts. Cash secured put. The maximum incurred loss potential is the difference between the strike price and the settlement price plus premium received. In theory, the maximum loss occurs if the underlying asset price falls to $0. In the example we used above, the maximum loss on the short $20,000 put option is -$18,000, -$20,000 plus premium received of $2,000. We can avoid the maximum potential loss by closing the position if either the premium or the underlying asset crosses a predetermined price threshold. Covered call. The maximum loss on the covered call strategy is the difference between the price of acquiring the underlying asset and $0 plus premium received. For instance, if an investor acquired BTC at $20,000 and sold an out-of-the-money call option receiving a $2,000 premium, the maximum potential loss is -$18,000. -$20,000 plus premium received of $2,000. To avoid the maximum potential loss on a covered call, the best practice is to place a stop-loss order against the underlying asset, and if filled, immediately close the short call option position. Wheel strategy returns. The results from the trading the wheel strategy will vary depending on several things. The total amount of premium collected. Options expire worthless. Before an option eventually expires in the money, the more premium you collect over time, the greater the chance of success. Predicting trend reversal points in the underlying price. The aim is to buy low and sell high. Selling puts towards the range lows and calls towards the high will improve profitability dramatically. Timing implied volatility. Sell options when implied volatility is high by historical standards. By understanding these three fundamental factors, you can enhance the potential profitability when trading the options wheel. Wheel strategy. Tips. There are a few things you can do to get the best results from the wheel strategy. Sell put, call options at a strike price you believe will expire at the money. Sell options when implied volatility is high relative to the historical volatility. Write options with between 30 to 40 days to expiration to take advantage of time decay. Set up alerts to notify you when an option is about to expire. Margin requirements. The main goal of the options wheel strategy is to gain the underlying asset in order to write call options against it. For this reason, you should maintain a USDC balance high enough to cover the cost of buying the underlying asset. Once the underlying is acquired, account holders with a minimum account balance of 1,000 USDC can use Bybit's portfolio margin mode to reduce the margin requirements when selling covered call options. Portfolio margin mode combines the positions to determine the portfolio's overall exposure. Here, the long exposure, long underlying, will net off against the short exposure, short call, resulting in a lower combined margin requirement than if holding the positions individually. The main advantage of portfolio margin mode is it requires less capital to manage a hedged portfolio, increasing the buying power of the account capital. Theta decay impact. Theta decay complements the wheel options play by reducing the value of written options, especially as expiration draws near. By selling short-dated options with between 30 to 40 days to expiration, you benefit by exploiting the steepest part of the curve where the premium decays the fastest. Implied volatility effect. Volatility measures how much, and how fast an asset price moves up or down over a given period. Markets with small day-to-day price swings are low volatility and markets with bigger day-to-day price swings are high volatility. The key difference is the high volatility stock has much bigger price swings along the way. This is usually accompanied by a high IV. When trading options, we express volatility in two different ways. Historical volatility, as the name suggests. This tells us how much the price of an asset moved on a day-to-day basis over a particular period. Implied volatility. Implied volatility, IV, is the measure of how volatile the options market expects the underlying asset to be in the future. All things being equal, the price of options rise when IV increases and falls when it decreases. Understanding the relationship between historical volatility and IV is a great tool to have in your belt when selling options. Here, you can assess whether IV is high or low by historical standards. To maximize profits, a good rule is to sell options when IV is high compared to its historical average. By doing this, you will command higher premiums and benefits if IV reverts to the historical mean. Benefits. Here are some advantages of the wheel strategy. Investors can earn a passive income by selling options and collecting premiums. The received premiums effectively lower the purchase price and increase the sale price of the underlying asset. Time decay works in favor of this strategy. Cons. Here are some cons of the strategy. Both the cash-secured put and the covered call have limited upside potential and significant downside potential. Rising implied volatility works against this strategy. Cash settlement means investors must make additional transactions, buying or selling the underlying asset, when employing this strategy. Risks. The short put option expires in the money, exercised, and the underlying asset price jumps higher by an amount greater than the premium received before the investor executes their buy order. The covered call expires in the money by more than the received premium and is exercised at a net loss. Believing the underlying will continue higher, the investor chooses not to sell, but the market turns lower, resulting in a mark-to-market loss. Wheel strategy versus covered calls. If an investor already holds an underlying crypto asset, they may skip step 1, writing cash-secured puts, of the wheel strategy and jump straight to selling covered calls, step 2. In the event a call option is exercised, the investor may choose to sell the underlying crypto asset and begin the wheel strategy from step 1. Wheel strategy versus buy and hold. When executed correctly, the options wheel can yield better returns than a traditional buy and hold strategy. Though sometimes, simply hodling may be more profitable. One of the deciding factors is how much option premium the writer will collect. It's possible that writing options with 30 to 40 days till expiration may not result in a strike expiring in the money for several months. Here, the banked premiums could be considerable and used to finance the purchase price of the underlying asset, thereby achieving a better cost basis. This is clearly a positive for the wheel strategy. However, it doesn't account for lost opportunity. Although selling put options is profitable if the market moves higher, the put expires worthless and you keep the premium, it limits the potential profit to the amount of premium received. If you believe the price of the underlying could go up more than the amount of premium you will receive for selling a put option, buying the asset outright makes more sense. Similarly, selling calls against your underlying crypto works well when the market is trending sideways, or slightly lower. Here, the premiums provide an income stream and hedge against minor declines in the underlying crypto asset. But in a rising market, you're better off not selling calls, as you could miss out if your crypto has a bullish run higher. Wheel strategy versus credit spread. To understand the difference between the wheel strategy and credit spreads, let's look at how credit spreads work. A credit spread is a two-legged option strategy where an investor sells one option and buys a further out-of-the-money option in the same underlying with the same expiration date. The credit spread gets its name because the short option is always closer to the money than the long option and subsequently has a higher premium. For instance, investor sells one BTC $20,000 put option with 40 DTE and receives a $2,000 premium. The investor buys one BTC $18,000 put option with 40 DTE and pays an $800 premium. Here we see the investor receives a net credit of $1,200, premium received of $2,000, premium paid of $800. The main difference between short options used in the wheel strategy and a credit spread is that buying the further out of the money strike limits the potential loss to the difference between the strike prices minus the premium received. When only selling the $20,000 put option, the maximum downside is $18,000 minus $20,000 plus $2,000 premium received, and a maximum potential profit of $2,000 premium received. Although trading the above credit spread only generates $1,200 of net premium versus $2,000 when trading the put alone, the most you can lose is $800, $20,000 to $18,000 plus premium received of $1,200. Alternative strategies. Because the short option elements of the wheel have limited upside and significant risk, the strategy may not be suitable for investors with a lower risk tolerance or for those prepared to take more risks in order to achieve greater profits. However, the wheel strategy is essentially a range trade where the aim is to sell puts close to a local low and sell calls close to a local high. Knowing this, we can look for other strategies with different risk profiles that are used to express a directional view. Here are two alternatives. Option collar, mildly bullish, low risk. Here an investor buys the underlying asset and, at the same time, buys a protective out-of-the-money put option and sells an out-of-the-money covered call. It may look something like this. Buy 1 BTC at $20. 000. Buy 1 BTC $18,000 put option with 40 DTE and pay an $800 premium. Sell 1 BTC $25,000 call option with 40 DTE and receive a $300 premium. Cost. A net debit of $500. Premium paid. Premium received. Max upside of $4,500. $25,000 minus $20,000 to $500 net debit, assuming the investor sells the underlying at the expiration date. Max downside of $2,500, $20,000 minus $18,000 to $500 net debit, underlying sold at the expiration date. Risk reversal, bullish, high risk, an investor sells an out-of-the-money put option, using the premium to finance the purchase of an out-of-the-money call option. For instance, sell 1 BTC $18,000 put option with 40 DTE and receive an $800 premium. Buy 1 BTC $22,000 call option with 40 DTE and pay an $800 premium. Cost $0. Premium paid. Premium received. In this example, the investor neither makes nor loses money if the option expires between $18,000 and $22,000, has unlimited upside potential above $22,000, and significant downside potential below $18,000. Conclusion: the options wheel strategy is an advanced options play that is best suited to experienced investors with a solid knowledge of the options market. Though this particular strategy may be too technical for less experienced options traders, the beauty of the options market is that there is something for everyone. Whether your view is bullish, bearish, or even neutral, you can profit using options at a risk level that suits your financial situation.
So we hope that you found the information in part 1 in our series on the options wheel strategy for beginners helpful to you. Hopefully it has helped you understand what the options wheel strategy is and how the options wheel strategy can be used with various asset classes as a potential long-term strategy for consistent income, as well as hopefully you can see how this could be used with different trading styles to generate additional income for your trading style. So again, we hope you liked this information and found it helpful. We hope you will smash the like button. Again, this is part 1 in our series on the options wheel strategy for beginners. We will be releasing further videos on the options wheel strategy for beginners in this series. So we hope you will subscribe to our BeachBum Trading YouTube channel. Hit the bell icon, select all notifications so you will be notified as we release subsequent videos in this series on the options wheel strategy for beginners. Please also let us know in the comments if you're familiar with the options wheel strategy. Have you used it? Has it been successful? Is it a good way for you to generate consistent income for your trading style? Again, in the comments below, in our free Discord, for which you can find an invite in the description box below, in our Facebook group, via social media, etc. Also, if you have any questions about the options wheel strategy and how you can use that, as a long-term strategy for consistent income and or to generate income with your trading style, please let us know in the comments below, in our Discord, our Facebook group, and or contact us directly via social media. So again, we hope this all helps. We hope you like this, and good luck and have a great trading day. The content of this video was produced by BeachBum Trading. We hope you will choose to also join us in the BeachBum Trading community and subscribe to our YouTube channel. Visit us at our homepage at beachbumtrading.com, the bum without the U. Similarly on Twitter, BeachBum Trading, bum without the U. On Facebook and in our BeachBum Trading Facebook group. Please follow us on Pinterest and on Instagram. All of the links to our social media sites will be included in the description box below, and we hope you will choose to subscribe to our BeachBum Trading YouTube channel and follow us on social media. Thank you. We also cordially want to invite you to our new BeachBum Trading Community Discord server, where we can have discussions on all topics related to trading, success in trading, investing, etc. You can see alerts when we make trades, changes to our watch lists, etc. So again, please join us in the new BeachBum Trading Community Discord server. You should be able to find a link in the description box below. You could also find a link in the social media category on our webpage, beachbumtrading.com, without the bum without the U, and also in the link section on the About page of our YouTube channel, etc. So again, we look forward to seeing you in the BeachBum Trading Community Discord server soon. Wave and say hello. BeachBum Trading also now has a site on Patreon. If you are willing and able to help support our efforts to produce all the content and help you achieve the financial freedom you want, deserve, to be able to live the BeachBum lifestyle or any other kind of lifestyle you would like, and you're willing and able to help support our efforts in these regards, we hope you'll choose to visit our Patreon page. You can get access to our new BeachBum Trading Community Discord server, which is currently under construction, but you will get access to the Discord server by supporting us through Patreon. Again, this is all currently under construction, but you can see we just have the default levels, membership levels, but again, each level allows support, allows access to our Discord. We're also posting our trade positions initially in our Discord, and again, we greatly appreciate any support that you're willing and able to provide. So thank you for your consideration. Another way that you can help support BeachBum Trading and being able to produce frequent quality content for you for free on YouTube, etc., is in addition to subscribing to our BeachBum Trading channel, hitting the like button on our videos, and hitting the notify so you're alerted when we release further videos. You can also choose to show your support for BeachBum Trading with a super thanks, which you can find below this video. If you hit the heart with the $sign, the super thanks, again, you can financially support BeachBum Trading in whatever amount that you wish, and we greatly appreciate your support, and that will help us, again, be able to produce frequent quality content that we can provide for you and all your fellow BeachBum traders around the world for free on YouTube. So again, we greatly appreciate all of your support, and thank you very much. Thank you again for watching our video. We hope that you liked it. If so, please smash the like button, give us a thumbs up. If you're not already subscribed, please consider subscribing to our BeachBum Trading YouTube channel. Please share this video with your fellow traders and friends. And please give us your feedback and any recommendations for improvement in the comments section below. And let us know what else we can do to help you in your trading career. Thank you again. Good luck and have a great trading day. If you like this video, we hope you will choose to subscribe to our YouTube channel by clicking on the box in the upper left hand corner. You can watch another video like this by clicking on the box in the lower right hand corner. And we have a whole playlist of videos like this that you can access via the box in the upper right hand corner. Our latest video is available in the box in the lower left hand corner. We hope you like this and have a great day.